Okay, we are ready to start. Thank you very much for being here today. My name is Roger Medina from NetSuite Nordics, and I will be your co-host along Gary Cokins, who are in this call, and I appreciate his time today. Uh, if somebody wants to make a question during the presentation, please use the chat, and I will summarize your question to Gary when he finishes his presentation. So uh, let's start on an important message. Just shared yesterday during the Suite World event in Las Vegas. Uh, According to recent studies from IDC and PwC, 60% of the companies are already thinking that will embrace the combination of AI with human judgment. And 48% of those companies are already building at this moment predictive models and scenario analysis capabilities. So if you are not on this any of these numbers, probably you need to think about it. And that's why Gary today is going to share with us how to start if you haven't started already on that. Uh, this event is part of the series of knowledge sharing that we have at NetSuite EPM for NetSuite Nordics. We have our blog, we have our LinkedIn channel, our YouTube channel, and of course this webinar. So let me introduce Gary. Gary is a person that I personally admire a lot. He is an international speaker, an author of different books in performance and cost management. He has a bachelor degree with honors from the Cornell University, an MBA from the Northwestern University Kellogg's School of Management. Uh, he worked with Deloitte. He was trained with Harvard Business School's professors Robert Kaplan and Robin Cooper. So he is author and co-author of more than 10 books. So 10 books related EPM, activity-based costing and analytics too. And he has been in the last years CEO and a consultant himself to his own company, Analytics-Based Performance Management, LDC, that it's authority on the themes that we are going to discuss today. And I appreciate a lot that he is a big believer of giving back. So that's why he's supporting us today. And I appreciate a lot, Gary, for being here today. So without saying any more, I will stop sharing, pass the control to you, Gary, so you can start your presentation, please.
Okay, it's got host disabled participant sharing. You've got to give me back. Oh, there we go. 1 second. You see my landing slide?
Yes.
All right, now let me go to, there we go. Whoop. All right, well, thanks, Roger, for inviting me. There may not be time for questions. This is 45 minutes before Roger does a little demo. So if there's not time, and for some of you who are just listening to this archive, you can directly email questions to me to my email address. You may want to write it down, gcokins@garycokins.com. Also, in my website, along the below the horizontal tabs are many articles that I've written related to what we're going to talk about here. They're all free. You don't have to pay for anything. I'm not trying to sell anything. All right, a little bit more about me. My degree from Cornell was actually in industrial engineering and operations research. It was in 1971. And if you're doing the math, I am 75 years old, but I feel like I'm 45 years old. But I got involved at the age 27 as a financial division controller for a large conglomerate. So I've been in the accounting and finance space ever since. But I always like to say I'm an engineer masquerading as an accountant. You gotta think like an engineer. Why are those books there, the 10 books? I think careers have a lot more to do with luck and circumstances. And as Roger mentioned, in 1988, I was recruited to KPMG. I was with Deloitte 7 years, But to be trained by Harvard Business School, Robert S. Kaplan, everybody recognizes his name from the balanced scorecard, but he did the pioneering work in activity-based costing. I implemented it for 5 years. I wrote a book, and that led to other books. And you don't need to buy the books. In fact, don't accuse me, oh, this guy's trying to sell his stuff. No. But if you go to wiley.com, WILEY, almost all of the books have the first chapter as a free download, so it's free. I did spend 16 years with SAS, SAS. Some of you may not recognize SAS, and it's not Scandinavian Airlines. It's the world's largest privately owned software vendor, 15,000 employees that specializes. So let's get going. Who will benefit from this presentation? Professionals who struggle with implementing enterprise performance management methods for their decision support systems. Professionals who intend to champion any or all of the enterprise performance management improvement techniques, and they need a compelling call to action. And the reason I have champion in quotation marks is it's been my observation that although it's nice for senior executives to sponsor new ideas, innovation, they are often preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3 levels down in the organization chart who ask themselves, how long do I want our organization to continue to perpetuate using stale or arcane or out-of-date or flawed methods? And they're the ones that'll do a proof of concept or a pilot to demonstrate to their coworkers, line managers, executives above them, that this is the way to go. So if you're early in your career or many levels down in the organization chart, that's fine. I like presenting to you. So my agenda, I first going to have to describe what are some of these methods and define what is EPM, then how to implement them effectively. But the real purpose of this presentation is a real frustration with me. What is taking so long for organizations to implement these? What are the barriers and obstacles? I'm briefly going to talk about the impact that artificial intelligence will have on the accounting profession, and then I'll conclude with how do all these things fit together. So, what's enterprise performance management? It's actually the integration of multiple methods, with each one embedded with business analytics, like segmentation analysis, if you will, but especially the predictive analytics, which I'll talk about. To achieve, the purpose is to achieve the executive team strategy, make better decisions. So the next 10 or 15 minutes, I'm going to talk about 4 primary methods. First one, analytics. And, I could put a definition in here from Wikipedia, but regardless how you define analytics, there should be no argument what is its purpose. Better decisions, better actions. Analytics goals should be to gain insights and foresight. That's for the future view, to solve problems, make better and quicker decisions with more accurate and fact-based data, and to take actions. So this briefly, here is a sort of a continuum of analytics. When we look through the past, I call that the rear view mirror. We start with descriptive analytics, pie charts, histograms. Then we have diagnostic. Notice there's a black dot. That's an outlier. So you can basically drill in for, what's causing that. Now we go to the future view, predictive analytics. And you may have noticed one of my books was Predictive Business Analytics that I co-authored. And when I wrote that, I thought, oh, this is Mount Everest, as high as you can go. But in the last 4 or 5 years, the higher level prescriptive analytics, think of it as optimization. Second EPM is the strategy map and the balance scorecard, which I'll talk briefly about, that were created by Professor Kaplan and Dr. David Norton. What I have here is a diagram that shows the strategy map going into the balance scorecard. But above that is something arguably more important. It's the vision and mission statement. That must be defined by the executives. That's their job. They need to answer the question, where do we want to go? And they need to set direction. But what the strategy map and the balance scorecard answers is a different question. How will we get there? What are the projects, initiatives accomplished, and so forth? Now, you notice the map is going into the balance scorecard. Many organizations allegedly claim they have a balance scorecard. This may surprise you. I think the strategy map is 10 times more important than the balance scorecard. The balance scorecard is just a feedback mechanism. You have to really start with the strategy map. Now, here's a fictitious view of what a strategy map looks like. A little bit of background. The reason Kaplan and Norton created it were 2 reasons. One, they knew that executives were reacting to financial results reported at the end of the fiscal period. They said, you need to shift your attention to non-financial metrics created during the period. And they created these 4 perspectives that have cause and effect relationships from bottom to top, learning and growth and initiatives that and these rectangles are strategic objectives in the map. If you're accomplishing learning and growth, they'll contribute to accomplishing the internal process improvement objectives. They'll contribute to customer retention and loyalty, and then eventually the financial. The other reason they created it is most managers don't understand the executive team strategy. I mean, hypothetically, if I went into your organization and randomly interviewed 10 employees in the hallway and said, quick, 2 minutes, can you articulate the executive team strategy? How many of them could do it? Maybe none. So what this does is it helps communicate strategy to the managers and employees in a way that they can understand it. Now, in each of those rectangles will then be such things like what are the projects and the initiatives, what are the KPIs, and so forth. So to summarize, if we start at the bottom, a learning environment will stimulate process excellence. That'll lead to customer intimacy, retention, loyalty, and that'll create the financial value for shareholders and owners. Let's move to the third of the 4 methods, management accounting. In many organizations, there is mistrust of the management accounting system with its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, channels, customers, and outcomes. And this was what led to interest in activity-based costing. And just briefly, I know some of you are going to say, oh, ABC, I heard about it. It doesn't work. It's too big. It's too complicated. No, it does work. It's just that when they were implemented in the past, typically consultants, too large, too complex, no one can understand it. Briefly, I'm going to share a way that you can right size and implement ABC in 3 weeks, not 6 months. Here's a simple, what is ABC? Here's how I explain it. Imagine you go to a restaurant with 3 other friends. You order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, hey, let's split this check evenly. How do you feel? Not fair, not equitable. Well, that's how products and standard service lines, I use standard service lines because service organizations apply to this too, banks, insurance companies, travel agencies. That's how they feel when the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread to the products and service lines using cost allocation factors like, number of labor hours, number of units produced, services delivered, square feet, square meters, head count by department. None of those cost allocation factors reflect the unique consumption that the diverse products and services consume of the end-to-end business processes and the work activities that belong to those processes, which in turn draw on and consume the expenses. So the simple explanation of ABC is as if the waiter or waitress brings 4 individual checks. You only pay for what you consume. It's basically a better way using cause and effect relationships. Now, the reason there's interest in ABC has to do with this chart. On the left side, almost every manager on the planet Earth recognizes the traditional responsibility cost center statement, salary, equipment, travel, and so forth. But when a manager receives this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And the answer is not much. What ABC does is it converts the data into information. Data and information are not the same thing. Data is transactional. Information is basically a conversion of it. So now in the middle, we've got it the language of work, key scan claims, analyzed claims. Notice it's the exact same amount of money, $914,000. And then we reassign each of the activity costs to the product, services, customers, just like the waiter or waitress in the restaurant, there's that cause and effect. I like to say on the left chart, when a manager gets this kind of report, they're either happy or sad, but they're rarely any smarter. What activity-based costing does is it makes them smarter. Now, I've rotated the previous diagram 90 degrees. It's not as simple as, we just take our resource ledger expenses, put them into activity cost pools. No, it's a multi-stage cost assignment because we have support departments that support other support departments that ultimately support the frontline departments that make products or deliver services or interact with customers. So it needs to be multiple stage. Now, I want to warn you, the next slide is going to look complex. I'm just going to go through it for 2 minutes, but the slide afterwards, and you will get a PDF of this, will have a link to a 20-page article that I authored that explains all of these slides. So there's the multi-stage cost assignment network. We've got the 3 universal components. We've got the resource expenses at the top, the work activities in the middle. They eventually pile up into the final cost objects, the products, the customers, and so forth. All of those arrows, think of them as thin straws or wide pipes, where the diameter reflects the amount of money that flows through. That's why this always reconciles exactly. So if the organization spent, let's say, $2 million or euros in January, it will be the exact same $2 million of work activities, and they will pile up exactly to 2 million to the customers and the business sustaining at the bottom. What is business sustaining? There will be some expenses that have nothing to do with making products or interacting with customers. Things like the legal department or where the accounting department is closing the books each month. It's not assignable. It's typically at about 10%. So what we do is we create a final cost object like senior management, and we trace it there. At the bottom, I refer to this as the predator food chain. Large mammals eat small mammals eat plants, so you can see that the customers are actually buying the products. Now, the products are going to be, and services are going to be accurately traced, but when they get consumed through the sales register, if you will, then the customers got it. This will allow us to do customer profitability. Notice there are 2 red boxes not going in the work activities, not going to the products, going directly to the customers. Those are going to be channel distribution expenses, marketing expenses, and so forth. So we want to get a profit and loss statement. The message here is costing is modeling. It is not T accounts and journal entries. And I mentioned to you, since I went through that quickly, you're like, oh, I couldn't understand them. If you go to the link that you see, and when you get this slide, there'll be a 20-page paper I wrote. It's called the Statement of Management Accounting. I wrote it for the Institute of Management Accountants. You may be familiar with the IMA, 140,000 members. I'm a 30-year member. What's the results from ABC? It's always shocking. This is typically referred to as a whale curve. So the black line at the top is with using that multi-stage cost assignment network. The vertical axis is the net revenues minus the properly calculated ABC costs. The horizontal axis is the cumulative buildup of the profit, but it's rank ordered, starting with the most profitable product, second most profitable product, and so forth. Notice the very last data point will always reconcile exactly with the profit and loss statement, $2 million there. It's always organization shock, and you're looking at real data here from a real company. The shock is, it said to them, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable product. You lost $6 million on the remainder to net out a 2. And they can't believe it, because that butter spreading creates that blue line. It's crushing and suppressing any accuracy. It's not detecting all the diversity and variation of the consumption. So as a result, the executives basically, and people are making decisions on bad data, and there's consequences. When they think that a product is really profitable and it's unprofitable, the sales force may be selling more of it. So the more they sell, the more money you lose. ABC really resolves this. Now let's talk about customer profitability. The only value a company will ever create is the value that comes from its customers, the current ones and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like the ones you have today. But we have a couple of problems. The accountants are not calculating customer profitability. They're stopping halfway down the income statement at just gross profit margin analysis. They're not including channel distribution, marketing, selling, and cost to serve. So visually, if the entire rectangle here was the expenses for the fiscal period, let's say January or February, the accountants are only calculating for the shaded. They're not including distribution, sales, marketing, GS&A. Now we have another problem, angel customers and demon customers. What do I mean by that? Every company has high and low maintenance customers. Example of the high maintenance customers, this is the demons. Always changing delivery schedules, always demanding special, not standard product, always returning goods, always calling help desk. Low maintenance customers, the angels, we love them. never change schedule, never only buy standard, never return goods, never call help desk. If those two types of customers at polar opposites bought the same volume, same mix, same price, they are not equally profitable because the high demanding demon are causing you so much more cost and lower profit. The message here is sales volume is not equivalent or reflective of profit. What really caught my attention about this book was the subtitle, Discover Which Type of Customer is Which and Turbocharge Your Stock Price. And what this really means is customers are the source of wealth creation for shareholders and owners. And we need to connect our actions and interactions with customers so the result is for the shareholders. Incidentally, this book was written by two marketing faculty at Columbia University. There's not much in it about management accounting, so you're not going to learn by getting the book. Now, this is a decomposition of the multi-stage cost assignment network. I won't go through it. It is in that 20-page paper, but the message here is that the activity drivers come in flowing from left to right. We're getting layer by layer by layer, and it produces this, a profit and loss statement for each customer. And it's layered like an onion skin. And in this fictitious example, you'll notice that they had a composite average 30% gross profit margin for the products. But between the 30 and the 8, 22 more points of profitability are eroded and lost, all with, if you will, channel distribution, marketing, and selling. So if we calculate these two broad swaths for every customer, we can put them on a grid that looks like this, where each circle intersection is a customer. And you'll notice that the message becomes clear. The most profitable customers are in the upper left because they're buying high profit margin from you and they're easy to serve. That's the angels, you know. The devils are in the bottom right because they're buying low profit mix from you. They're difficult to serve. So now the name of the game is move the dots from the bottom right to the upper left. And Roger, that would be another webinar from someone from marketing or sales. How do you do that? But one example would be unbundling and fee-based. You know, charge those demon customers individual fees for all that extra work. Look, the airlines have been charging us for baggage. The airlines charge us to go from a middle seat to an aisle seat. The banks have been charging for depository accounts. That's how you move the dots. What's really happening here is the CFO must shift its emphasis to help, instead of just piling up on the operations people to get their costs down, help marketing and sales better target customers. The spending budget for sales and marketing is critical. It should be treated as a preciously scarce resource aimed at generating the highest long-term profits for shareholders and owners. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, to win back, and which types are not attractive? And the ones that are attractive, the next question is, how much should we optimally spend attracting, retaining, growing, or recovering each customer microsegment? The reason I have optimally in quotation marks or in italics is because it is an optimization. You can overspend on customers and destroy shareholder wealth. You know, you can underspend on customers and risk their defection to a competitor. Now let's move to the fourth, one of the many components. Think of all of these elements or components of enterprise performance like a gears and machine. Here's the problem. The budget is typically a fiscal exercise done by the accountants it's disconnected from the exit team strategy, and it's not based on future driver volumes. It's not volume sensitive. So real quick, how many of these boxes would you describe how you do budgeting in your company? It's invasive and time consuming with few benefits. It takes 6 months to beginning to end. We start in July to end in December to publish it for the next year. It requires 2 or more executive tweaks at the end. For the first draft, the executives don't like it, go change numbers. It's out of date a couple of months after we produce it. So that's why we want to move to rolling financial forecast. Starves the departments with truly valid needs. In the next fiscal period, a department may need a lot more people, but we don't give them it. It caves into the loudest voice and political muscle. Look at me, bald hair, gray hairs, all those 60 years. They're veterans. They know how to pad the budget. They want to protect themselves. You know, in fact, notice the one, they're sandbaggers. In case something goes wrong next year, they don't want to basically be accused of having unfavorable budget variance. It incorporates last year's inefficiencies into this year's budget. So if the process is inefficient this past year, it's replicated. The last one bothers me the most. When a manager is on a glide path, let's say October to the end of the fiscal year, and they can see they're not going to have spent all of the budget that was allotted and approved, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that their next year's budget is going to be pegged to how much they spent this year. We call it use it or lose it spending. How do we resolve this? Think of the amount of money needed to be spent as a result of two river streams. The upper river stream is the recurring, repeatable expenses. It's going to be demand driven, customer demand, customer placing orders, volume and mix. The lower river stream is non-repeatable, non-recurring expenses, and that's going to basically be derived from projects. Projects have beginning to end, and I'll tell you, there's three types of projects. There's capital projects you're all familiar with. There's strategy projects to accomplish the strategic objectives in the strategy map, okay? And then there's enterprise risk management projects for mitigating risks. So let's go to the upper river stream. How do we basically solve that? What we do is we calculate the ABC model backwards. See, for the historical view used for strategic purposes, the spending was known. We didn't know the other, so we use ABC to calculate it. But we get a bonus when we do ABC, unit level cost consumption rate. What's the cost per automobile loan? What's the cost for a deposit in a bank? What's the cost for a material move in a factory? All those activities will have a unit level rate. And then I call this my Industrial Engineering 101. I think it was my second semester of freshman year at Cornell University. The equation is customer demand, volume, and mix times those unit level cost consumption rates equals the capacity required. In other words, number of type of employees and their salary and wages and purchases with suppliers. So effectively what we're doing is we're calculating it backwards. Now let's go to the projects. Enterprise risk management. This is a popular grid by the ERM community. Each of the circle is a potential risk event that will happen in the next fiscal year. The diameter is how much money would be to mitigate the risk. The vertical axis is the severity of the impact. The horizontal axis is the probability. Now, you can't basically spend money to mitigate every single possible risk, but for the blue ones, let's spend money there. Now, I've decomposed the two river streams. The shaded boxes was that upper river stream. And you notice you go from the management accounting, we bring in the unit level consumption rates from the top, we bring the forecast volume and mix from the left. That gives us the capacity resource plan, number of person hours, pounds, kilograms, number of employees, and then we monetize it. We put it into a currency. Now, at the bottom left, you can see there's the three types of project: capital budget, capital projects, strategy projects from the strategy map and balanced scorecard, risk projects. Now, why is this a very important slide? Because since the budget is going to be out of date in a couple of months, if we refresh the forecast, we can recalculate it through this. And this is where NetSuite comes into play. We need FP&A, financial planning and analysis, calculation tools. That's really what NetSuite is. It's basically a modeling tool, that becomes a system when you've calibrated right. Now, we will still have the same problem that we have with traditional butter spreading or traditional budgeting. Notice at the bottom right, I've got a diamond there with acceptable. When we give the executives those results, they're going to say, not enough money there. What should we do? Give it back to the managers. Okay, they change some of the numbers. But the temptation might be, well, why don't we postpone or eliminate some of the capital projects? We already justified them with their ROI. Why don't we postpone or eliminate the strategy budgets? Bad, because if we don't do those, the executives won't achieve the strategy. And that's another reason why strategy maps come into play. Failure to implement the strategy well, or the risk control. So you get the idea. This is how to basically do driver-based and rolling financial forecast and budgeting. Now, implementing. Some of you may be saying, Gary, you're starting to persuade me we should be doing this ABC, but it's going to be a mudslide of data. There'd be 2,000 activities in it. IT would have to extract driver quantities from all the business systems. It's just not worth the effort. And that's what led to some of the problems in the past. And the consultants, and if the consultants are listening to me, feel free to communicate with me because, yeah, I am 75. I will train you how to do what I'm describing here for your clients. I came up with a technique several years called rapid prototyping with iterations. It starts with a one-day workshop, 5-6 cross-functional employees in a room, build an ABC model very quickly, high level, client doesn't have to buy the software. Next day, we bring in the other line managers, the executives above them. They see what was constructed very quickly. Purpose was not any accuracy. And the light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading overhead. Oh, that's how we can see our profit margins by layer. Oh, that's how I can see which our customers are more or less profitable, and so on and so forth. Then a couple of iterations takes maybe 2 or 3 weeks. You have a permanent, repeatable production system. 3 weeks, not 6 months. Make your mistakes early and often, not later when the system is too hard to change. You know, in the traditional way, sometimes the consultants would take 6 months because they want those billable hours, make a lot of money for the partners in the accounting firm. And then it's such a big model, no one could understand it, not maintainable. Why does rapid prototyping work? It has to do with this chart. The vertical axis is the accuracy of what you want to know. Horizontal axis is the administrative effort to collect the data, calculate the data, report the data. You will always get an asymptotic curve where the accuracy goes up quickly and then becomes diminishing returns and extra accuracy for the extra level of work. Look at the slope of the black line. It goes up very quickly, stops at 95%. Good enough. Stop there. And what determines that slope? The single one that determines is the multi-stage cost assignment network. It's not timesheets or all of that other stuff. Building that, constructing that modeling network is what gives you the accuracy. And stop at 95%. It's good enough. Remember, this is management accounting. This is not financial external statutory reporting. Yes, for the external statutory reporting for government agencies, if you get those numbers wrong, you go to jail. But if you get the management accounting numbers wrong, you don't go to jail. So it can be just good enough to make better decisions. Is the higher climb worth the better view? Now, the title of this talk was The Barriers and Obstacles. This is what really concerns me. What is taking so long? And I like this cartoon chart. You've got this answer board. To the left, simple but wrong. To the right, complex but right. Look how many CFOs and accountants are taking the left path. It's so convenient to allocate overhead on labor hours or whatever, because those transactional data already exist. It's more difficult, but not that much difficult, 3 weeks to build the cost assignment network and using ABC. Also, look to the left, they're falling off the cliff. That's because they're going bankrupt because they were using bad data. Now, what's the barriers? There are 3 I'll start with. First, technical barriers. They're IT related. Dirty data, source data that came in was originally entered, but the IT function has a tool called extraction, transform, and load, ETL, and it can, like a water purifier, it will clean up and basically get consistency. Also, if it's a multi-division larger company, they may have different hardware vendors, Dell, IBM, Hewlett-Packard. IT can solve that. The second problem is that perception barrier of excess complexity and affordability. And I described to you, and Roger said at the beginning, I'm going to describe how to implement. I already showed you that the rapid prototyping can get you in. What I didn't describe, but I'll just do it verbally right now, to get a strategy map and a balanced scorecard, you can do that in 2 days. The technique I use there, just visualize this, is I have the executives the night before fill out 20 yellow Post-its with SWOT, strengths, weaknesses, opportunities, and threats. You're all familiar with the SWOT analysis. In the morning, across the wall, left to right, I've got the 4 perspective: learning and growth, the process, to customer, to financial. I said, go to the wall and put the yellow Post-it under one of those 4 easily. Then I say, now all of you go to the wall, don't talk to each other, look at other yellow Post-its and move them adjacent to ones that are similar. And you know what? In 30 minutes, there's 2 to 3 clusters of yellow Post-its under each of the 4 perspectives. Wow, that's the strategic objectives. 10 o'clock in the morning. Now the rest of the day with the executives, what are the projects and initiatives for each of the 20? What would be the KPIs? Very fast way of building a strategy map, a balanced scorecard. Instantly, the next step I tell them is I suggest rather than come back tomorrow and do this more slowly, because this was like 18 holes of golf on a polo horse, delegate the strategy objectives to your first line managers, have them define the projects, have them define the KPIs. Why do I suggest that? Well, one, they're going to understand the strategy. Remember the 10 employees in the hallway, but more importantly, they're going to be held accountable to targets on those KPIs. So we want their buy-in that they define the KPIs. Now, here are some excuses why organizations have not implemented these methods. First one, we're profitable, so why does it matter? Well, you may not be profitable forever. We will purchase software that will fix our problems. No, software, you basically got to really do the modeling with it. We already know our true costs from our general ledger financial reporting system. No, you know your true expenses. You don't know your costs. All costs are calculated. You calculate costs. We have done it this way forever. We don't do that here. We already know everything. It's in our heads. That's pretty arrogant. Next, we are a small organization. We'll worry about better methods when we get larger. Many people ask me, how large do you need to be to basically implement these methods? I start 25 employees. When you even have 25 employees, if you've got diverse products and services, that's going to create complexity that creates overhead. You're still going to need to have activity-based costing, even if you're only 25, employees. Next, all this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants. They can do something you can't do. They can focus. They've got a statement of work, they've got an engagement letter, they've got deliverables at a certain end date. They're basically motivated to basically implement. You're too preoccupied closing the books and all that stuff. Next, no one looks at the reports I create. There's no point in generating better reports. Well, that's sad. Here's a really well-intentioned accountant, creates a nice report, gives it to the line managers, they throw it into the trash can. Next, we cannot afford better software to fix our problems. It's not that expensive. Next, we are way too busy doing other things. What are you doing? Closing the books. It's taken you, if you will, all month. Close the books in just, a week or just a few days, so you've got extra time to implement these things. Finally, we don't know where to start or how to get started. And I gave you two examples, rapid prototyping with iterations. Here is a longer description. I am going to read through this because I think I moved fast enough, Roger. We're going to have enough time that I'll be done. Why do people not do ABC? Perception that it's too complicated and complex. There's a belief that the extra benefits do not exceed the administrative effort to implement the system. And I already mentioned rapid prototyping with iterations gets it in 3 weeks, not 6 months. Oh, here's a problem. Consultants wanting lots of billable hours. So they construct a large and complex AB system that's not understandable. It's too big, can't maintain it. Next, the CFO worries that I'm going to have 2 accounting systems. I'm going to have the external financial compliance for regulatory agencies using generally accepted accounting principles, GAAP, and I'm going to have the internal management accounting system using ABC for insights. And their worry is we're going to confuse the managers. Which cost do I use? I did a project for Clorox, a large company here in the United States. And what the CFO did with the ABC system was really, he wrote a letter to every employee and says, as of today, all decisions will be using ABC. Only the accounting department will use the GAAP external reporting. There's this perception that employees must have to fill out daily timesheets. Employees hate timesheets, and you don't need timesheets. You just need managers to estimate percentage estimates. And finally, there's this belief that the higher cost accuracy from ABC won't be that much, maybe 2-3%. No, sometimes it's 30, 40, 50%. So for example, a product under the butter spreading is $100 under ABC, it's $170 or it's $20. So what's going on here? What is required by hopeful EPM method implementers is the soft skills of behavioral change management and educating managers and employee teams about EPM. You need to have these soft skills of change management. Most of you are what I call Newtonians, like Isaac Newton, the physicist. To you, the world's a big machine. You need to be somewhat like Charles Darwin, Darwinian, sense and respond, how to overcome the resistance to change, because that's another issue here, what the barriers are. Fear, it's not has to do with systems, with technology or systems. There's resistance to change. It's human nature. People like the status quo, don't rock my boat. Fear of being measured, fear of being held accountable, fear of others knowing the truth. I don't want others to know, So you're going to need soft skills, change management skills, and they need awareness of the benefits of the EPM. Briefly, our robotic process automation, RPA, and artificial intelligence is going to significantly impact the accounting profession. One, transactional jobs, and jobs are going to be eliminated. Accounts payable clerks, payroll clerks, the computer is going to watch their tasks, their keystrokes, they'll take over. The month-end close, all of the transactions will be done. Auditing is going to be replaced by a computer, and the audit firms, those CPA partners on the audit side, they got to start paying attention. They make pretty big salaries. They're going to have to shift to management advisory services that are not for their clients to continue making those nice salaries. If you are from a CPA firm, contact me. I will train you on how you can basically help build your management advisory services. BPO, all of the outsourcing, same thing. Regulatory agency reporting, SQ will also be accomplished. So let me conclude. Here's a diagram that I've created. How does all this fit together? The big blue box is your organization, your people, and your assets. Notice I've got the customer loyalty line going over to shareholders. Remember, I said customers are the source of value, wealth creation to the shareholders. Let me describe how this works. Oh, first, where's management, accounting, and analytics? I deliberately did not put it in because the output of them is the input elsewhere. How does the diagram work? Start at the box customer satisfaction. To the left, there the executives will formulate the strategy based on needs of customers. Then they will communicate it down to managers using scorecards, dashboards, KPIs. That gives the feedback to the managers. Imagine if every employee every day could answer this one question: how am I doing on what is important? Well, they wake up in the morning, they look on their computer screen, the dial, is it favorable or unfavorable to the target? Now they know that. And if every employee knows it, how are we doing? So that whole left side is strategy management. Now the CRM, customer relationship management, that's the targeting, which types of customers are attractive to retain, to grow, win back, and acquire. Now we've got the counterclock circle. That's the process world. That's the ERP world. That's the lean management, Six Sigma. Take the customer order, complete the order. So here's the point. All of these flowing bubbles, they're happening every minute, hour, day, week. They're like veins in your body from your heart system. But if any of those veins are restricted or constricted, like you've got, inefficient processes, or you're targeting the wrong customers, notice the money doesn't all flow to the shareholders, it leaks to the sewer. So I'd like you to think of this slide as the vision of what you want for your organization to basically have. The last slide, when you get them, has some links to some articles I've written. So the action steps for you is get educated. Thank you very much. You're doing that by attending or listening to this webinar. Get buy-in. Do not underestimate the amount of resistance to change that your managers will have. Rapid prototyping. Start small, think big. I like to think of it as crawl like a baby, walk, run, fly, soar. Get it fully implemented. I don't have expertise with motivational theory, but you will need some sort of incentives, whether it's bonuses or the like. So, Roger, I landed the plane. I thought I'd do it in 45 minutes. So there is my email address. Any of you who have questions or comments, if you want to write me about what you enjoyed about this or what you didn't enjoy. Some of the consultants, some of the CPAs maybe actually feel like I was mean to them and insulted them. But, you got to get into the 21st century. So, and my website has all the articles. So now I'm going to stop sharing my screen so you can take over, Roger. And there we go.
Thank you very much, Gary. We have some questions that I would like to share with you. Just before, let me, we have a couple people waiting in the waiting room. So we will send We will send the recording to everybody who register anyways, but let me share the questions that I have. We have a question from Pedro in Florida. He says that, hi, Gary. Uh, well, Mr. Gary Cokins, I greatly admire your work. I have two questions for you. First, is activity-based costing applicable only to manufacturing companies, or it can be also used effectively in service industries? And the second question is linked to this. What are the potential benefits of implementing ABC in a hospital setting?
The first answer is absolutely. ABC is universal, whether it's service organizations, even government sector. One of my books is value-based creation for government, because even government needs to know the cost of, cutting lawns and serving their citizens and building schools. Incidentally, in the United States, I learned that there are only 8 out of every 100 jobs make tangible products. The other 92 are services, banks, insurance companies, travel agencies. So Pedro, it's universal. They all will have activities. They will all have processes where the activity belong to. They'll all have activity drivers because they need to basically use them. Hospitals, those CFOs, they're going to get mad at me. They're really in the 1970s. They're not measuring patient profitability. One of the articles, if people are interested, I think it's in my website, I co-authored Measuring Patient Profitability. They need to know the cost per protocol, per surgery, and all of that kind of stuff. So Pedro, the answer is yes, yes, yes. ABC is applicable to service organizations, also healthcare and universities. Deans and faculty need to know which courses are more net cash flow, we won't say profitability, and so forth. Are there any other questions,
Yeah,
Roger?
we have a couple. I mean, one of that was already, I think, answered in some way by you. It was by Danny in Denmark. Is asking how big the organization has to be in order to implement exceptional EPM CPM systems. You mentioned 25, but he made another questions that probably I think is something that could be not completely clear to participants and could be interesting. Is how the question is this: you highlighted the exceptional that exceptional EPM CPM systems are often the exception rather than the norm. For companies looking to implement or upgrade their systems, what would you say are the most common barriers they face in transforming their EPM, CPM systems from adequate to exceptional?
Yeah, and you're referring to, I know, an article that I wrote for a website called FP&A Trends. I think if you just do a search FP&A Trends, and maybe then if you get to their website, search on my name and you'll see my articles. That's called, EPM, are the exception. I think I'll just repeat what I covered. Do not underestimate the resistance to change. People don't like change. And so you're going to need those skills. One just suggestion, because the practice I've done to overcome change, and we got to get to your demo, but real quick, is an equation or a formula called D times V times F is greater than R. You may want to write that down. D, because R is resistance, it's a huge number. D stands for discomfort with the current state. V stands for vision of what better looks like. F stands for first practical steps. They're multiplicative. So if any of those three are low or zero, you can't overcome resistance. The key is D, discomfort. You got to create discomfort. Ask them pain questions. Executive, are we measuring the right things? Do we know where we make or lose money? Do we know which customer is more or less profitable, and the like? Once you've created that discomfort, job limiting, don't get yourself fired, they're going to say, well, how do I fix it? Now, here's where the EPM solutions come in. And then they say, well, how do we do that quickly? Bing, there's the first practical steps, rapid prototyping. All right, Roger, I think you're going to show a little bit about NetSuite.
Yeah, I'm gonna do that, Gary. Thank you very much for your presentation. As always, it's very helpful, and I really appreciate the time. So let me start this few minutes just to share what is gonna be the last part that I think a lot of people are going to be interested too. That is how the application looks like in real life. So I'm going to start first showing a little bit about how. I don't know if you see my screen, everybody.
Yes,
Yes.
yes, see
Okay.
ya.
Perfect. Thank you, Gary. Okay, this is this is one of the modules of the NetSuite Enterprise Performance Management. As you can see, is based on the new Redwood interface that Oracle and NetSuite have developed together, and recently was announced in Las Vegas. I think it was yesterday, the day before yesterday. So you can see NetSuite is gonna look more than what you are seeing right now. And basically, a big difference, in my opinion, and here, Gary, if you have a different opinion, please share it. The difference of an EPM solution to a business intelligence solution, a big difference is that we have a collaboration environment here. You can see here that it's not just data, it's data that you are interacting as a team. So, for example, here you can see you have a dashboard where you have the announcements of the team. For example, you have a due date of this October to submit the sales plan, in the 15th of October to submit the compensation, the last day of October submit the operation team expenses. So you as controller or responsible of FP&A, you become an orchestrator of everything. So that's the first part, is that this is a collaboration tool. But of course, we all know that something very important of any tool is the reports that you submit to the management team. So the capabilities the tool has, and remember that everything that you are seeing here is synchronized with your ERP. This is real-time data that you are synchronizing on real time. So you can see here, for example, that you can have the overview of the earnings per share depending on different scenarios that your company could face. For example, you have the baseline for your earnings per share, but for example, if you become in an expansion phase, or if you become part of you are in an acquisition mode, you know, the different strategies to growth, you can have all these different mode alternatives for your plan of 2025. Of course, we can you can have two all kinds of KPI information, like for example, it has the capability to interact with a geographical database. You can, of course, have the traditional data of the balance sheet, and you have different scenarios as we discussed, and you can go and in more detail. So, but you already know that any, let's say, tool like this has it. But I want to go in two aspects that, in my opinion, are differentiators and some strengths to NetSuite, and that our customers that we have implemented this really like it. As I already said, you have this is a tool that allows you to have a interaction with you and the whole team. So that means that you can set up an action plan, for example, as we are seeing here, to define, for example, which are the revenue assumptions, and you can define who will be the responsible in your organization to define the assumptions that you will use. So you as FP&A are not the leader of that, and be part of that too, and then you get complaints that the data that was submitted was not the right one. So you make sure that the person who owns the data is the one who submits that. For example, which are the headcount and salary assumptions should be probably HR or the HR leader, or if we are talking about the operating expenses, the same. I mean, you make the business areas to work on that. So that's a very important functionality that the system allows and that the application allows. Uh, and lastly, well, not lastly, I want to show to the reporting capabilities that it has is they are reporting capabilities, for example, that automatically every month or every day can send automatic reports to the people that you define are relevant to get this. So could be in PDF, could be in Excel. The format that you define, so that you define is totally flexible. So this is something very important on this too. And before I move to the next application, I want to show you two things that, in my opinion, are key. Uh, One is the capability to make predictive analytics on this. For example, you can see here that you have a forecast that your team submitted, that your sales team submitted, but you use some predictive planning capabilities that the tool has embedded, and you define based on some confidence intervals that you define based on, let's say, could be on, like in this case, on Monte Carlo analysis, but could be two on machine learning analysis, depending on the data sizes that you have. For example, here you define that, for example, product X, you have three different scenarios that could happen: the best case, the worst case, and the most likely. And this is data that you get automatically from the tool. It's not something that you need to be creating or doing. This is NetSuite EPM predictive analytics capabilities that are based on that. And finally, on this area, I want to show you that we, as EPM for Nordics, and thank you to the alliance that we have with Azure and company, we are in the possibility to implement the rapid prototyping models that Gary is saying on our own demo environments, that so you can use that, you can see how that will be created before you actually buy the solution from NetSuite and engage on a 1-year contract. So this is something that we can offer to you as customers. Let me go to another application that it's very interesting to several of you, that is the accounts reconciliation. You know that accounts reconciliation is a pain for most controllers at the end of each month. You need to define how are your risks analysis on the different accounts. You need to test that actually the balance sheet and the information you provide to your management team is actually represented the reality. So how do you do that? Well, NetSuite has this new tool that again gets all the information from the ERP, and basically what it focuses is to establish the reconciliation process in an automatically way. For example, here you can see you create, well, let me first go to the word list. You create a word list with the different priorities on, for example, which are the accounts who have higher risk, lower risk, and that you need to reconcile every month, for example, every quarter. Then, of course, you have a list of all the transactions that you need to reconcile, and has a important module, well, important functionality talking about the transaction matching too. This is I will not go into the detail, but you know that this is a new capability that eases a lot the process that usually you do through Excel or through manual information to getting the data from the bank accounts or other data. So that's basically what it is. So I will stop here of sharing. I think we have a last question. I think I already answered that. There was a question to me, but I want to share here in case that Gary wants to answer. The question to me is how do you conduct, Roger? How do you conduct an activity-based costing and management rapid prototyping project using enterprise for performance management tools? Well, first, of course, when we are talking about ABC, there is a module from NetSuite EPM that is profitability and cost management. That's the module that we will use it. Very few people knows about that module. We have consultants in EPM for NetSuite Nordics that know it. And of course, what I will say, I will partner with Gary on this engagement to make sure that we use his methodologies in order to make that rapid prototyping and save as many hours on the implementation. Gary, what do you think about doing that?
I welcome training. I really prefer to train consultants how to do what I can do, because then I know that they'll be training they'll be delivering this to their other clients, because it's altruistic. I said in my thing, you said I like giving back. I like giving back to line managers. They deserve better information from their accountants, but I loved rapid prototyping. I fell into it. Even Pedro San Martin, who asked the first question, has capabilities of providing the rapid prototyping methodology.
Yeah. Thank you very much. And just to stress what you lastly said, same as you, Gary, we as APM for NetSuite Nordics, we want to develop the skills not only with the customers, but with the actual NetSuite ERP implementers too. So please, if there are NetSuite ERP implementers already working with the customers, please rely on us. We can integrate as part of your team, as our goal is to spread the voice on all the NetSuite ERP customers. So, well, we have this is 2 p.m. and 1 in Oslo. It's 8 a.m. in Eastern time in the US, where you are based, Gary. I appreciate a lot that you woke up very early today again, and that you donated your time to us and to the community of NetSuite today.
My pleasure.
Okay. See you next time, and thank you very much, all the participants. Thank you very much.